I know we are all neck deep in elections, but that doesn't make the half-year earnings season any less significant. Stanbic has released half-year numbers, and the last time we had this conversation, we were with Abraham Ongenge. There's a new sheriff in town. Dennis, welcome on set.
Thank you very much, Julians. Thank you.
Karibu sana. You have very good numbers, but there's no dividend. And I'm concerned about this largely from the optic standpoint, because last year you just resumed from the COVID stay. Now again, there's no interim dividend. Why is this the case?
Yeah, Julians, we appreciate that our investors expect a return on their investments. And that is why just 2 months ago, we paid 50% of our 2021 earnings in dividend that was approved in May and paid immediately after. One more thing that our investors appreciate is sustainability in the business. And our ability to continue to grow and to serve our customers and to yield even better returns. And what you've seen in the results shows that growth. Our loan book has grown 31% since last year and 17% this year, first half only. We are seeing very good pipeline going into the second half of the year. And we would like to continue along that grain of growing. And therefore, the approach we are taking is to say, can we resource, can we finance that growth into the second half of the year and deliver even better performance and returns towards the end of the year?
Aren't you bothered by the optics of this? Because you just resumed the post-COVID, if I could call it, dividend payment last year. Now, in this case, again, you are holding back. Are you gravely concerned about the prevailing risk environment?
No, we are not concerned about the optics of this. At least not as an immediate issue. Why? We have paid dividend consistently in good and in bad times. You would remember last year, when businesses were just recovering from COVID, we were one of very few entities in the market that paid 1.7 shillings in dividend amidst a pandemic. So we are not concerned about macros and what's happening in the environment. We think that we will continue to grow. We want to continue financing that growth so that we build on the return to our shareholders. And our shareholders don't just appreciate our cash dividend. If you look at our share price and the capital gains that it has made over the last 18 months, it's gone up 23%, which is quite remarkable. So it's the consolidated return that they look at.
Okay. And speaking about the growth, I think your loan book is up quite significantly. And I'm curious, in terms of your retail corporate books, how does this growth look like?
It's a mix of we've got three business segments, the way we look at the market. We've got the corporate investment banking sector that has grown quite significantly. We've got the business and commercial segment where we look after SMEs and enterprise businesses, and that has also grown, not as much as the corporate sector, but also grown quite well. And then we've got our retail, our consumer high net worth area where we lend to the individuals segment of the market. That has grown quite well as well, considering that we launched digital lending last year. So we've seen some very, very decent growth across all the sectors. But CIB, corporate investment banking, has been outstanding.
Okay. When you look at your loan to deposit ratio, up by a significant margin, and as an onlooker, my question is this Stanbic signaling to the market that, look, we are recalibrating our risk posturing in this market? Perhaps we have been too conservative for too long.
We have a purpose in this market. we say Kenya is our home, we drive our growth, and South Sudan is our home, we drive our growth. The way we do that, if I just unpack the two segments to that ratio, which is your loans and your deposits. So the way we think about the deposit side of things, we don't just look at customer deposits, we look at the entire set of resources we have, which is beyond customer deposits. Then we ensure that we have sufficient resources to finance customer needs, which is why our liquidity ratio is 16% above what the regulator kind of requires. So that is positive. Now, on the asset side of things, we continue to live our purpose in that we have selected segments that are critical in the growth of this market. We are into oil and gas, we are into consumer, we are into power infrastructure, we are into trade, we are into SMEs and MSMEs. And what we've seen over the last year or two is more collaboration, more working with our customers in these segments to support their businesses, and that is why we're seeing the growth that we are seeing. Are we changing? Are we opening up the taps for from a risk appetite perspective? We continue to review our risk appetite and ensure that obviously we are growing responsibly, and that is why our non-performing loan ratio continues to gradually come down. It's now 8.5% from more than 10% a year or two ago.
Speaking about your asset quality, at 8.5%, it looks to me as though Stanbic Bank is operating in a very different market from other players. Because when the industry average is flying at above 14%, how are you managing at 8.5%?
It is a dividend of many years of work. Our NPL ratio was into 11, 12, early teens percent a few years ago. And that was driven by some deals, some segments. And what we've done over time is to walk journeys with those corporate or those customers and find win-win solutions for the bank and for the customers, and to cure their businesses. And we've seen a dividend of that in most of those assets then turning back to performing. Part B of that is also entrenching ourselves in our customers' businesses, ensuring that we understand their cycles, ensuring that we understand the yesterday, the today, and the tomorrow of their businesses, and ensuring that our financing needs are not project-based, they are not event-based, but they are relationship-based. So that also has helped that journey. Part 3 of that is also how we profile our credit facilities. So the learnings we've taken from the times we had those high NPL ratios have taught us how we think about lending, scoring of customers, ensuring that we've got the right profiles of customers, and entrenching ourselves in understanding them. All that leads into the gradual decrease in the NPL ratio that you've seen.
Okay.
Yeah.
Your customer deposits are not growing as fast as your loan book growth is.
Yeah.
And I'm concerned about your funding mix and how you're able to sustain the loan growth. Just explain that to us.
We think about this in 3 pieces. Number 1, the loan to deposit ratio is a ratio we pay attention to on a daily basis. So we want to ensure that we've got sufficient deposits, obviously, or to finance the assets and other resources. Part B is the profile of the deposits and matching those to the profile of assets that we have. So that is another important aspect, and that is something that we monitor very carefully, and we are very comfortable in terms of how we match those, both in terms of tenor and also in terms of currencies. So talking to the point around mix. Part 3 of this is also looking at our shareholders and ensuring that we are managing the cost of funding. You will see, for example, that our interest expense this period has gone down. And that is on account of ensuring that we are judiciously looking at how we are financing. We are financing the deposit book. The evidence of all this is we've been able to support a 31% growth in loans with a fairly stable deposit base through the cycle. The one highlight I have to make is we've actually seen good deposit mobilization in especially the retail side of things. But obviously on the corporate side of things, when there are options, as there have been in the interest rate markets, we would see through the cycle, we would see some customers look for yields elsewhere. But overall, we are comfortable with our resource pool and ability to sustain the financing needs we have.
Okay. Your operating income notched up by about, I think, 23 or so percent.
Yeah.
When you look at the cost side, not up significantly. The net effect here is that your cost to income ratio has really improved.
Yeah.
But I'm curious, with your cost to income ratio in the high 40s, at what point will you feel that we have extracted efficiencies enough and maybe now we might not be optimizing on what we have in terms of we're cutting too much on costs?
Yeah. Our cost and efficiency play has been a long journey. About 3 years ago, our cost to income ratio was mid-50s, 56, 57%. Last year we closed at 50.9, 51%, if you like. We are now at 48%. Why has that happened? We've continued to relook at our processes internally, especially customer-facing processes. So we've digitized customer onboarding. 98% of our accounts are now opened digitally. We've digitized lending. A significant chunk of lending now happens digitally. That gives you savings as a matter of course. We've also looked at our technology estate to ensure that we don't have duplications in that space. We've also looked at other aspects of our operating model. The one thing that we are clear on is that we can't save our way to prosperity. All right? So there is a minimum. And we think for us that sweet spot is in the mid-40s. So we want to get to a point where our cost to income ratio is in the region of 40 to 45%. We are working towards it. We are clear about the things that we are doing about it. But that is not at the expense of ensuring that we are making the right investments to continue growing.
Okay. One line item which jumps at anyone who looks at your numbers is the foreign exchange trading income, which is up 46%.
Yeah.
Clearly, you're not complaining about the present situation where some of us can't get dollars. The spreads must be really working for you.
We are entrenched in certain sectors of this market which do give us both sides of Forex. We are a big player in the oil and gas sector. We are a significant player in trade, especially the Chinese corridor and Middle East corridor because of our ICBC linkage. We have entrenched ourselves in customers and players in those markets, and that has enabled us to have both the supply side of currency and the demand side of currency through the period. So the result you have seen is a result of being able to meet client demands on both sides of the curve throughout this period. And obviously, yes, we've seen some increase in demand over the period, which we've been able to meet and solve for those clients in those sectors. And it's something that we want to continue doing to ensure our clients are growing with us.
And at the more macro level, do you see the situation as improving as far as the accessibility of hard currency is concerned?
I think there is signs that it is improving. There is less media mention of this issue as was 2 or 3 months ago. So my reading of that is to say that whatever the issue there was is self-solving, and we do think as the year progresses, then it will continue to dissipate.
Okay. Yeah. I want to switch gears and talk more about the operating environment.
Yeah.
So let's start from here. We've had a long-running conversation about the risk-based pricing models. And to the best of our knowledge, a number of banks have received the green light from the market regulator. Is Stanbic one of them? If not, how far are you with this?
Stanbic has not yet received approval for the risk-based pricing model. We have gone through several iterations and received feedback from the regulator on our application. We are very clear about the principle that the risk-based pricing seeks to achieve, which is fairness and transparency among other principles. We have submitted our latest iteration of application. We do believe it answers those questions amongst others that have been posed to us, and therefore we are very optimistic that this is going to be closed very shortly.
Risk-based pricing in an environment where the government issued a year-long moratoria on CRB listing for any entity with a loan of 5 million and below. Do you see any complexities around that? And has that moratoria in any way impacted your appetite for risk in the market?
CRB listing is one among many data points that we use when we are scoring our customers or assessing the credit worthiness and pricing for our customers. We think we have other data points fairly rich, including our entrenchment and understanding our customers' businesses and their cycles that I mentioned earlier, which enable us to continue to lend to our customers. We think there might be an effect on new-to-bank customers, those that we haven't understood very well. But our first prize is to understand the business of the customer before we get into the data and your standard statements and transaction flows and CRB listing and all that. So focusing on customer relationships, focusing on client focus, focusing on the businesses and the needs that our customers have gives us the data that we need for the most part to be able to make lending decisions.
Okay. Yeah. Some players have mentioned, to me at least, that one of the key concerns around this issue of the risk pricing model is how to handle the fees upon loan origination by banks. Is this an experience you've shared, and how are you going about it?
It is one of the complexities in thinking about the transparency and the all-in pricing for credit facility. We have there are various theories around how you go about it, but we think where we've gotten now in terms of the feedback we've received from the regulator, this is an issue we should be able to surmount. I think there are two broad principles there. Number one, does the customer understand the total cost of credit that they get and not multiple pieces here and there. So that's the first part. And number two, does the collection or recovery of the money you've lent, including the interest and fees and everything that you put into it, the all-in cost of that credit, is it commensurate to the timing of the effort? By the way, the whole concept of facility fee implies or is a recovery of the operational costs that you spend during when you're doing the lending effort. If I'm going into a lending relationship, the fact is at the initiation stage, that is when we draw up contracts. If there's collateral, that is when we do perfection of collateral. If there's, that is when we do the CRB credit, scoring pieces. So facility fee has basically been a compensation of that. Now, the question going forward is how do you balance that all-in price with when you actually collect the compensation you get for these efforts.
Okay. Yeah. Still on the operating environment, we've had a lot of spillovers coming from tensions from Russia, Ukraine, where inflation is trending right now. How do you see Stanbic Bank positioning itself, at least in the medium term, in light of this?
The environment has been difficult, so let me phrase it this way. 2020, 2021, 2022 have taught us to take a year at a time because every year has come with its
unique challenges.
The challenges we are going through now, globally and locally, are things that we can surmount. So how do we think about them? We think about them in the context of our purpose. We ask ourselves, in the context of a COVID environment, for example, if I go back to 2020, how do we continue with our purpose that Kenya is our home, we drive our growth? We do business, but then also support communities.
Your interest income from fixed income securities declined. What's happening there, Dennis? Where on the yield curve are you playing?
So when you grow your loans to customers by 31%, you naturally rebalance the profile of assets that you have. Part of that has been to divest from some of the other asset categories, including interbank placement, including financial investments. And that is where you've seen some of that delta come through. So if I look at the interest income in total, it's up 15-16%, looking at it on total basis. And we see our investments in financial instruments issued by the government more as a liquidity play. We would prefer to lend to customers and continue driving customers' growth than keep that money just for the yield. So to the extent that we can redeploy those assets to customer client franchises, we think that is the approach we'd like to take. Okay. But we look at the total interest income and we are comfortable that it's trending right.
I see. How is the Sudan business doing?
The South Sudan business remains profitable. It remains focused on the areas we've chosen to operate in South Sudan. We support oil and gas sector in South Sudan, which is very important in that market. We support the international development agencies in South Sudan, which is also very critical. We support our corporates and their employees in South Sudan, which is also very critical. We are very clear that for now, our strategy in South Sudan has been largely to be transaction facilitators and Forex intermediators, and we think that is what we would like to continue to do in South Sudan, and therefore the business continues to do well. Obviously, it will go through cycles of from a performance perspective, but we are not worried about the overall performance. As with any other environment, every so often there will be bumps on the road, and we remain committed to address those bumps on the road as they arise.
Okay.
We have very good relationships with key stakeholders, government and regulators in South Sudan, and we continue to keep those relationships warm to ensure that we can deal with any issues that come up.
And still on the subsidiaries side, SBG, the market has experienced a downturn for understandable reasons. The investable opportunities are quite eroded. And SBG has been playing in the big ticket size space, at least to keep the business flowing. Is there anything in the pipeline working?
SPG had a good Q1, and then as the environment obviously got into election mode, what happens naturally is you've got, these types of deals kind of get put on hold. We do think that we will see that pipeline start to come back in the second half of the year. So that business is healthy and continue to solve to do significant transactions. You will remember late last year it supported customers in the MTN transaction that was happening in Uganda. So continues to do well. I hasten to say that SBG Securities has the second highest market share in equities. So yes, it has been a depressed market in terms of equities trading, and therefore when you look at the absolute numbers, they look lower, but it's actually a significant player in there. So we are getting quite a big pie of what is gettable from that market in the current conditions.
Okay. Final question, Dennis. A number of players have intimated to me that they're in engagement with the market regulator for the reinstatement of the account to mobile wallet fees. And when I looked at your fees and commissions line, you know what happened there. And I thought potentially you're one of those who are actually pushing for this. Is that the case?
Our fees income through this period has actually gone up. As we've continued to diversify our sources of fees, which is really transactions and the return that we get out of that. You're right, it is a fee line that we would like to see coming back. And it is really just a compensation for the investment we make to avail these platforms. What is it all about? It's about ensuring that you've got systems that can facilitate and integrate what you have on the banking platform to what you want on your the telco your telco platform. So it is a fee we would like to see come back, but we've done what we needed to do to diversify our fee and commissions income. That is why, despite not being able to charge C2B, B2C, we are seeing growth in that line.
Dennis, thank you so much for your time.
Thank you so much.
Really appreciate it.